Hello, everybody, and welcome. I'm Bonnie Halper. I write the weekly Startup One Stop newsletter. I'll put the link in the chat. And I work with founders on their pitch decks and their talking points and their executive summaries and make introductions to strategic partners or investors where and when appropriate. I'm a super connector. I've been involved in the industry since the early days of Web 1.0 in New York and Silicon Valley. And every 2 weeks, we host these online insights with one investor and a small self-selecting group of entrepreneurs so that everyone has the opportunity to participate. And I want to thank Joseph for hosting us. Tell us about you, Joseph.
Thank you, Bonnie. Good morning, everyone. Joseph Katz. Been in the startup space for 15 plus years, operating on the marketing side. I help companies grow, go-to-market strategy, customer acquisition, everything under that umbrella. Happy to talk in more detail with anyone. I'll put my contact info in the chat. I encourage everyone to do the same. Keep the intros short and looking forward to today's conversation.
And we're finally hosting Trace Cohen again. It's been a few years, Trace. In fact, the last time you were our guest, it was in person.
It was the good old days.
Yeah, the good old days. So thank you. So do you want to tell us about your background first, or you want to go through the room and see who's here? And it's up to you. Either you can have the attendees introduce themselves, or you can kick it off. Up to you.
I'll start. Quick 60 seconds. Born and raised on Long Island. Live here now. Went to Syracuse upstate. Studied entrepreneurship. Started my first company out of college doing SEO and reputation management. That was 2007. It was acquired a few years ago for about $50 million. But after I graduated, I started a PR agency with my father. My parents had a tech PR agency they sold in the 90s. So PR communications has always been in our blood. Turned that into a digital media agency, ran communication strategy, digital media, and analytics for the biggest trade shows in the world. So if anyone's been to CES, Eureka Park, and dozens of other shows you'll never hear about and hope you never attend. And then in 2016, I became a full-time angel investor with my father. That's New York Venture Partners. It's our holding company for our 65 investments. At pre-seed and seed, generally $25, $50, $100,000 checks at less than 10 million valuations. Most people don't know I worked at American Express actually for the last 2 years to kind of get through this tech turbulence, and launched my first fund about 3-4 months ago called 6 Point Ventures, just to continue our success because we've been pretty good angel investors over the last decade.
I'll say. So let's have the attendees introduce themselves. Tino, you're on. And try to keep the introduction short, so.
Yeah, sure. So I founded a company. We offer high quality custom cabinets made locally for 40% less and delivered 4 times faster. And I put more information in the chat.
Oh, thank you. And everybody should do that. Eric.
Good morning. Eric Becker, I'm the founder and the CEO of Millimatch, and our tagline is Unleashing People Potential with Data-Driven Insights. So basically what we do is measure, analyze, and monitor employees and address things as retention, culture, engagement, and productivity through AI and algorithms.
I happen to love this company, by the way. Names keep popping around. John.
Hi, I'm John. I work as a healthcare fractional executive, but one of the side projects I'm working on is, I think would be interesting to a lot of people here, is I'm trying to kind of democratize the board director space, I guess you can say, where venture investors might have a marketplace to get board members that would work on their behalf as opposed to having to sit on them or within a limited network.
We have quite a few investors in the room. It would be interesting to hear their feedback on that. Kevin.
Yeah.
Are you muted? Kevin Williams. Oh, okay, we'll move on to Stephen Keys. Welcome back.
Well, hello. It's been a while.
Yes.
Yeah, Stephen Keys. I'm Canadian, founder and CEO of the KBO Group. We do basically 2 things: project financing and a little bit of startup financing that we drifted into this year, as well as management of funded projects, large capital projects. These are ports, airports, railways, shopping centers, things of the nature. And I've been in the innovation space for probably 15 years. I've had my own startup. I've done my own innovation. And I got patents to my name as well, engineer by trade. So Canadian, but I live in Mexico now because the weather is slightly better than what's up north.
Keep mentioning that you're Canadian. Was that an apology? Just kidding.
No. But usually, I mean, Canadians are typically not numerous in these kind of things. So
we usually have Ian here. He couldn't make it today. Michael.
Good morning, everybody. I'm Michael Nathans. I'm the co-founder and CEO of Whispersound Corporation. So we are a medical device and informatics company that's bringing a breakthrough treatment for sleep apnea through the FDA. We've done a couple of small rounds of investment. We've raised about $6 million so far. And we're positioned, we think, to get through the FDA pretty quick and chase down the market cap of the leading CPAP maker, which is ResMed, traded on the New York Stock Exchange with a market cap of about 30 billion, because no one wants one of those devices, unfortunately. And people aren't getting treated. The treatment rate's 5%. So we think there's a big market opportunity, and we've got a raise going on. If anyone wants to talk to me, I'll put my info in the chat.
Okay, thank you. Andrea, always good to see you. Although you're never rarely on camera, but still. Oh, you're muted right now. Okay, Kevin, do you want to introduce yourself? Otherwise. Lawrence, I forgot. I missed a few people because the names keep popping around. Lawrence. Oh, you're muted right now.
Yeah, I'm sorry. Lawrence Lerner here in Seattle. I am a growth strategist for the last 25 years. I've taken mostly tech product concept to launch. So I mentioned Catalina. They're in 31,000 retailers around the world. We deliver about 10 million a day. I build a lot of retail tech payments, helped launch Discover Card, took Cognizant past $1 billion. And I'm always looking for interesting technology to take concept to launch. Rolling out a new escrow business for one of partner companies, which apparently is a unique offering. So always happy to connect with people, hear your story. And like Bonnie, I won't call myself a super connector, but got a lot of connections and happy to share.
Yes, we do. Joe, how could I have forgotten? Like I said, the names keep popping around. Joe Myler.
Joe Milam here in Austin. 20 years running a multifamily office, securities analyst, portfolio manager at all. We were out there on Sand Hill Road, and I got exposure to the early explosion of venture capital when it took off in the mid-90s. And so we built a platform to execute on what I like to think of as a better way to deploy capital in the early stage venture asset class. I posted a piece in the chat box that just came out on Andreessen Horowitz's funds, and it isolated the very work that went into the platform we designed and built, which is to take more of a portfolio approach with proper diversification, stage capital deployment, et cetera. So it was a really interesting piece that came out this morning. But we built the picks and shovels. We licensed to folks that want to run institutionally rigorous venture funds and do what Andreessen started doing, and then went to the dark side.
Yeah. Kyle.
Morning, everyone. Kyle Barrios calling from Boulder, Colorado. As you can probably tell by my outfit, though it's not that cold today, probably low 30s. Former New Yorker, lived in Farmingdale, Long Island. So yeah, thumbs up from Faith there. Love my timing in Long Island, especially the summers, day trips to the Hamptons. But anyway, happy to be here. New angel with Rocky's Venture Club out of Denver. And as always, at the end of the year, reevaluating my opportunities and institution, and learning still quite a bit from the due diligence side of angel investing. So happy to be here. See everyone again. Thank you.
No, I was a Hamptons girl from way back. Lon, I missed the Hamptons.
Also a Long Island guy from Dix Hills. I run a company called First Insights, and we basically do user experience research. So included in that are things like contextual interviews, usability testing, focus groups. And our goal is to help any type of company, startup, enterprise level, understand their customers better, which leads to better marketing strategy and business strategy. I am currently, as we mentioned earlier, down in South Florida, and know Bonnie for many, many years.
Many years. I'll be visiting soon. Matthew.
So I am a consultant and advisor. I have my own firm that I run called Frank Consulting, and I also do chief investment officer position through an energy business holding company, really, where we do investments into energy and other type of technology. Based here in Silicon Valley. I'm from New York originally. Bonnie's just an amazing person. I just love talking to her. She's just great. And yeah, and that's why I'm here just to say hello again to the group. It's been a little while.
Yeah, that's good. Patrick, welcome back. Haven't seen you in a little bit.
Good to see everyone. Hi, Bonnie.
Hey.
Patrick Fraley. I am in New York City, here via North Carolina originally. Lower middle market investment banker, focused on M&A. Love working with founders, and look forward to chatting with everyone today.
Oh, thank you. Scott. Wait a minute. Names are popping around on IP. I apologize for that. Go ahead.
Oh, good morning, Scott Purdy. I'm one of the founders of Sine. We're based out of Philadelphia, although I live in South Jersey, just off the New Jersey Turnpike, exit 3. And our product that we have developed and are finalizing up now will take multiple inputs of video or movies from anywhere in the world, input them up into one place on our site, and create a professional looking movie in an extremely short amount of time. And I also part-time actor, so if anybody is looking to make a commercial for their company, and we actually are looking at the angel seed round right now. That's about right where we're at.
Thank you. Kyle Schofner, wow, it's been a while since we've seen you. You're muted right now.
Hi, Bonnie.
Hey.
Yeah, good to hear from you again. Yeah, I'm a Pittsburgh-based venture investor with a family office, Quaker Capital Investments. We're early stage generalists, and yeah, good to see you again, Bonnie.
Yes, welcome back. So, Andrea, can you time to are you able to introduce yourself right now? I know you're always multitasking. Or Kevin Williams.
Good morning. Hi.
Yeah.
Sorry about the mic trouble.
Okay.
My name is Kevin J. Williams. I'm with Catalyst Global Markets. We provide services to startups as well as early stage companies in regards to capital raising, business development, etc. We provide a number of introductions to startups as well as VCs, funds. Basically, we're involved within the technology sector, currently involved with engagements within clean energy, clean tech, EV. We also like to become involved with life sciences and airspace.
Oh, thank you. If I missed anybody, please feel free to introduce yourself right now. Otherwise, take it away, Trace. So what are you looking at? What are you investing in these days?
So our last investment was an AI company, definitely in the writing space, very technical team. So it's one of those things where you buy on the team to figure it out. But definitely AI. I like vertical AI because I'm a great investor, but I'm not the big tech fund. So I won't pay up the 50, 100, like multi-$100 million as like a seed round, as I'm sure you're seeing. Like Dev Agent just raised 50 million at a 500 million valuation. Great, amazing people, they deserve it, but that's not the game that we play. We find the diamonds in the rough. So I like the vertical AI where someone has an expertise, they can build and they can ship faster because they have the technical expertise, but they also have the vertical expertise in which they're going after. Data, I guess, is kind of a moat. I definitely learned in the last few years working at American Express and helping our clients sell into enterprise and corporates. One, it's all meetings and PowerPoints, way too many of them, but also budgets are set now for next year. And the biggest issue of why the startups aren't really getting the major corporate clients initially is compliance, where everything needs to be in-house. American Express, for example, can only use Microsoft AI. So they have Copilot, they use the Microsoft suites, but they can't use outside AI like ChatGPT was blocked, even though it's a partner, but that's a whole separate issue, is because they can't have hallucinations, they can't put out wrong data, but they also can't leak any data. So until it's 99.59s secure, a lot of the startups are mostly getting that kind of excitement hype. But then we'll see really if the valuations will catch up, because very few people, myself included, know where these big companies are going, right? OpenAI is a not-for-profit. They're figuring that part out, right? They had a good mission, but now they went to the dark side, raised tens of billions in venture capital. They're going to have to IPO at some point. No one can buy them. Maybe Microsoft will just kind of amalgamate them like the Borg. But I like the vertical AI space because outside the big tech companies, you're not seeing AI by anybody else. You have Amazon, Microsoft, Google, which just put OpenAI to shame with their new VO over Sora. Sora, if it was a few months ago when they first showed it, was amazing. Now they got completely leapfrogged, and VO by Microsoft is the new standard, and all the other Mid-Journeys, everything else kind of looks like a kid's toy. A year ago, blew our mind. Today, everything moves so fast. So we are looking. Admittedly, we kind of slowed down in the last year or two, just because as much as I love founders and it's my job to find the best, it's also my job to invest in companies that can raise more capital. There also is a game element to this as well. And so now definitely feeling better about the economy to some extent. Yesterday was just a little scratch. Great. Cut it 25 bips. Inflation, we'll see. But the public markets, it's interesting, day to day or week to week, kind of drive a little bit of sentiment in the private markets, even though any investment I make today will hopefully exit in 2 to 3 presidents. So it is hard not to be short-sighted when it takes years. It really does. We invested in Pinterest in 2009, and it took 10 years from the IPO. They went through the great financial crisis, and that's where we believe companies are being built stronger, more resilient, which is what's happening right now. And you can see all the Carta from data, from all the data from Carta, from what Dan Gray does, from PitchBook, what I write about, that at least the early stages, being an emerging manager or an angel myself, and now raising a fund, the big guys have raised, the top 30 have 75% of all the venture capital raised in the last year. Andreessen Horowitz themselves, with their $8 billion fund, is almost 50% of the entire market. So you're seeing these crazy rounds, high valuations. We'll see in a few years how many shake out, but so many companies from last year, like Stability AI and others that raised $1 billion, they're already out of business. It's amazing how fast it's moving, how many are still behind the scenes that you haven't heard of and you won't for another year, just because it's a bunch of scientists, PhDs, theoretical physicists, literally building technology. And the amazing part is, even when they launch in a year, they'll still get leapfrogged, probably still while private. So definitely interesting times. Things are moving a lot faster than they used to be, but I can't do my job and my work without AI. It's definitely been really helpful. I pay $20 a month happily for ChatGPT.
You know, it's funny. I saw an article this morning that said the new Anthropic study shows that AI really isn't hallucinating. It says no, AI really doesn't want to be forced to change its views. So there.
Right.
Yeah.
It's one of those things that most people don't fully understand it, like LLMs. I geek out. I have a few technical founders across a few AI companies that we invested in, and they try and explain it to me. Theoretically, I understand it. I try to invest in things that I at least fundamentally understand. So historically, as angels across all of our companies, because our background's in PR and strategy, we did no fintech, bio, health, education, insurance, nothing regulated. and there's very specific nuances to those businesses. But now that I've been in fintech, it really isn't that much more complicated than I had assumed now that I've seen how sausage is made. But that's why I like the vertical space. Is it going to replace a few jobs? Yes. But then again, everybody thought, right, GPS would take away jobs. Great. It killed MapQuest. Everyone thought the phone would take away jobs. Now we're addicted to it. Everyone thought the computer would take away jobs, and now we can't do our jobs without it. Robots, they're going to take away some jobs, but we won't be able to do anything without them. And the same thing with AI. The whole idea behind it is that it will augment the work that we do, as long as you don't get left behind to some extent. Some jobs more than others, but we're going to have to adapt to it like everything else.
Does anybody have any questions? We always open up the floor to questions, and I didn't mean to. Terry, you're late. Do you want to introduce yourself first? And if you have a question, please feel free.
Oh no, sorry. I just saw the announcement a few minutes ago, and I've got another jump I got to get to, but I wanted to catch some of this. Terry Carlone. I'm a co-founder and CEO of Vidient. We have a AI machine learning based health guidance used by individuals to lessen their reliance on drugs and improve their health.
Okay, thank you. So we open the floor to questions or comments.
Well, he opened up the AI conversation, so let's just
Yes, we did.
let's just go there for a few minutes. Trace, you mentioned ChatGPT. Is that your tool of choice, or what do you think is the gold standard now? I mean, ChatGPT obviously has a great market brand, brand in the market, but it's not the only tool.
It's not, and it definitely is my tool of choice. I've been using it for 3 years now, since I think you might remember something called ChatGPT 3, which came out in 2020.
Yeah.
It did good then. It was still kind of cool, like, oh, it can do some writing for me. It wasn't really able to search the internet and even read URLs. And so a lot of my research that I do now, that you see with Dan Gray and when I write my newsletter, is thanks to AI just expanding on my thoughts. I can talk to it, it can write it. It's actually interesting. It's all about prompts and how best to use it. So I actually say, interview me, ask me questions. And so I have a conversation with it, and then it coalesces it into a post. I rewrite it, put it kind of in my voice. But then we also have tools like Firefly AI, which I don't know, is it invited here?
No, it's not.
I invite it to all my calls, my Zooms, my Google Meets. And not only does it listen to everything, which is great, but at the end of the meeting, within like 5-10 minutes, I have an entire transcript of who said what, action items, bullet points. And so this is where it augments it, because what were we talking about? Who's working on that? You invest in this. And I'm trying right now to build out, at least from a deal flow perspective, meet with a company, they'll pitch me. I'll have a Firefly of the entire conversation, so it's searchable. But then I want to feed it through like GPT to kind of clean it up, to take out exactly what I'm looking for. And then there's a company like Velvet that will then build an entire memo around it. So I'm trying to create an entire flow of, I meet with a company, I get the AI overview, I snip it into what I want, I put it into a builder, and within an hour, I have an entire memo in the company, and it didn't take me really much work.
And if you automate that with AI, you'll have to do zero.
Almost there. Exactly. So I'm almost there. It's in the works. So they're startups and they're integrating right now, but we just download and insert it. So we're working on that. Maybe Zapier. So
yeah,
exactly. Yep.
That's awesome. Yeah.
Yeah. So very helpful. I say like the new BCs before ChatGPT. I don't know how we lived without it.
I know a lot of folks are, concerned, right? You mentioned the jobs. People are concerned
Yes.
about, it's like everything. You have to embrace it and learn how to use it properly, and it could be your best friend.
It is. It definitely is my best friend. The other ones, it's a consumer issue, right? So you have Perplexity. People are trying to get into that. They just raised another 500 million at a 9 billion valuation to take on Google. I think they're 1/100th the size, but still, that's within just a few years. Claude is definitely powerful. I just don't prefer it over GPT, and their advertising is really unique. It's like, hey, use the Claude, and everyone's like, what is this? So they have a little bit of a consumer issue. I think they'll be fine. Anthropic, like Amazon will probably just acquire them depending on regulation. But yeah, every major tech company can pick their own. Facebook, Meta, whatever you want to call them, is doing their Llama, which is open source. Elon and X, Twitter have Grok. And so everybody is trying to win.
Yeah. I wanted to mention that, before Google came along, Yahoo absolutely owned search. So, we can't discredit perp. Well, I was thinking about it, and I was thinking, now Google is a verb. Perp kind of, if you're looking for a perp, it's totally different thing.
Bonnie, but AI is going to change that verb.
Yeah, it's going to change it. Yeah. So I didn't mean to just focus on AI. If somebody else wants, if you want to talk about something else, or what else do you look at?
Trace, if you don't mind me asking, that fundamentally, I was just thinking about what you guys invest into and what your round size is and all that good stuff. What are we talking about in terms of the next year for you guys? What does that look like investment wise?
So angel wise, we were writing $25, $50, $100,000 checks. We have 65 of those investments over the last decade. And the round sizes were pre-seed, seed. Kind of the vernacular is around a 10 million or less valuation. We average about an 8 million entry point. So we didn't play the percentage ownership game that a lot of VCs do. They try and have about 10% at exit, but they can do optionality checks like those, like, oh, here's a few $1,000,000, come back to me if it works. I can spray and pray a lot of those and I'll lead the next round. And if I don't, somewhat of a signal risk that we're seeing a lot of orphans companies right now. For the next year, we just launched a new fund we're raising now for 6 Point Ventures, and we're just going to continue what we're doing now, vertical AI and deep tech. We have connections across a lot of investors. We have over 100 founders in our portfolio across our 3 partners, and we will stay true to our thesis. Everyone got a little crazy and drunk in 2021. We stuck to our thesis. People made fun of us that, like, oh, Andreessen's leading a 5 on 50. And my emerging manager friends, I love them. But it was a little bit of a game of, this is interesting, big tier 1 leading it. I get a logo, so I have to raise more capital. And in a few years, we'll see where it ends up. So there's a little bit of relationship building.
Sure.
But also half my fund is going to be invested in Israel as well. So they're the second best market outside the US, and the US is recovering. It's still difficult at the emerging manager, pre-seed, seed, like angel arena. But a lot of people have left that geographic for whatever reasons. And I want to lean in. That's how we've been successful in our career so far.
And then regarding the new fund that you have going, what are we talking about? How much subscription? How much you raised? What are you looking for?
It's gonna be, I'm not publicly disclosing any of that yet. So
okay.
It's gonna be pre-seed and seed. We'll make 3 investments. And so we'll start deploying next year.
Gotcha. Thank you.
Yep.
So next question.
I have a question. Thank you, Bonnie. Hi, Trace. I'm curious about one thing, because that's what my technology does, is kind of measure and evaluate founders and leadership teams. What do you look for, and what's the common denominator that you look for in leadership teams that you invest in?
At the early stages, grit and to figure it out. It's just a general comment, but it's one of those things, like when you see it, you know it. When you talk to a founder, they're hesitant. A lot of them are like, oh, we'll probably do this. We're hoping to do this. It's really kind of their mentality. It's like, you give me this money, this is what we will achieve. We're going to raise this. I'm going to hire this many people. I'm going to achieve this. It's one of those things that we like to correct people. They're like, oh, well, if this happens, and we're saying, no, when this happens. You can't have an if mentality. This is startups. You go belly to belly with your customers. Have you spoken to any of them? As I said before, we like vertical AI. Do you have an expertise in this field? What's your unfair advantage? Have you worked in this industry for 5, 10, 20 years? Most people think that the average entrepreneur is young gun out of college. It's a 45-year-old. They've been working for 20 plus years, maybe a little extra money saved up where they can take the risk, and they don't mess around. You won't see most of them tweeting. You won't see most of them writing. They're just out there doing founder-led sales. And so half the investments we make are usually pre-product, pre-revenue. So are valuations made up? Yes, but I want them to be somewhat reasonable. So as much as I would love to invest in a second-time serial founder who sold their first company for like hundreds of millions, billions of dollars, that's not the game I play. I find the outliers somewhat underrepresented that the big firms won't touch.
Mhm.
Initially,
Thank you.
most of them will invest after me.
Sure.
Thank you, Trace.
Next question or comment. So what else do you focus on besides AI? Everybody's
I play a lot of pickleball. So people send me a lot of pickleball deals. I'm not investing in anything pickleball related.
Pickleball,
The what?
pickleball equipment.
People send me equipment, they send me the leagues, the TV sponsorships. I'm not rich enough to buy into an actual team. That's a different game, but that's where the money is. And then it's like all the meetup and like find like local games. Like I stay away from any event tech. I was in that world for 5 years. I don't do marketing tech or sales tech. That's just a pure SaaS stack subscription, like grind it out. And we have 2 of those companies, former founders of Yext. So if you meet anybody who worked at Yext in like sales or account management, definitely dive in because they can sell. That's all they know what to do.
Oh yeah. Oh yeah.
Right. And so that was one of the issues that happened in like ZERP COVID, where a lot of people were smart. They got a little notoriety, a little press. People threw money at them because there was a lottery ticket, which is still what our industry is. And then they just sat back and said, keep us updated. A lot of the investors didn't lean in because they made so many investments. And so that's why we get into our deals and founders love us. We roll up our sleeves, we built and sold companies, and we go to bat for them. So people joke, like, what do you do all day? Like a third of my job is marriage counseling. People don't see the behind the scenes of like founders crying, fighting with their founders, fighting with their significant others. Like it is not easy.
Nope.
Not at all.
If you follow me on LinkedIn or Twitter, you'll see my memes all the time.
Mm-hmm.
You should also put the link to your newsletter into the chat, please.
Yeah.
Do that now.
Yeah, the world of AI is like changing so quickly. That's what we hope to incorporate in our product so that if you're making a movie, you may have the option with use of AI as we develop it more, where you could just, tell it, hey, just to pick everything out on people wearing green or the number 8 or the best angles for this, or possibly create your movie in the style of a Scorsese film or something like that. I know we got a little ways before we get there, but it's just exciting. But it changes so quickly, and the prices vary. We've been working with AWS to do a lot of the stuff so far.
Yep. And so there's a lot of that. I don't know how to differentiate it. It's all about sales and IP and contracts. And so that's the only thing that I have found that separates companies, because that's literally a moat by legality. One of my companies that was acquired earlier this year did AI for design, but I invested 6 years ago and it was a white paper and a bunch of like PhDs saying, oh, well, coding should be automated. Let me hand draw something, take a picture of it, and it will instantly code it. It's called Pix2Code, literally 6 years ago. And it took 4 years to get traction, thanks to ZERP and COVID, where people couldn't be in a room together. So it was great. You can prototype a lot faster. Product managers, technical engineers, and designers. It's a love-hate relationship. So if you can prototype a lot faster, they were acquired earlier this year, but they went from like 0 to like 1 million users in like 6 months when they launched, because it was the coolest thing at the time, but then everybody else did it. So they were acquired. It was a nice exit, but it definitely, because of all the competition, wouldn't have been a standalone business.
So my question is, and we know how hard it is to start a company, and we always go through hard times. Do you reach out to your founders, or you wait until they reach out to you?
A lot of them reach out to me. I hate to admit it that this is kind of like a warm intro world. I would say I've made 3 investments from Twitter, where I reach out to them. So I would say I invest more by reaching out to founders than like a cold email coming to me. And so I've gone viral a bunch of times, and when I do, I can't help it. It's a neuroses of mine. I check out every single profile. And a few of them like, oh, working on something new, stealth. I was like, okay, there's maybe 75,000 people on stealth on LinkedIn. Let me check out your background. So, oh, you did AI at Airbnb, at Loom, at Apple. Okay, great. Hey, what's up? We should probably chat. What's this new stealth company you're working on? 2 months later, we were in their pre-seed round, and now I'm doing one as well. We're doing diligence, second meeting in the next few days with the person who helped launch the Gemini Google API. They sent out a post, I'm leaving, and I said, great. Let me see what you're working on. Obviously, it's going to be something technical and interesting, but I want to see everything, and it's been difficult.
Yeah. Yeah.
So Craig, welcome. Do you want to introduce yourself?
Morning, Bonnie. Sorry, I'm a few minutes behind out here in Los Angeles.
I can hear morning.
I'm glad I can hear you, Trace. Great to see you, Joseph. Joe, thank you always for including me. Craig Isaac, I'm, as you see behind me, the Chase logo. I work with small business banking out here in Beverly Hills, which basically is from startup all the way to lower middle market. I'm basically a feeder for our entrepreneur group. And I've been doing this for about 25 years. And I always share with Bonnie that this is my original AI art behind me. And so I hope if you need AI art for anything editorial, it's my passion and my interest. So let's talk offline. Great to see everybody this morning.
Oh, so
Go
next.
Chase.
What? Next question or comment. Oh, I was going to ask, with the current fund or with the new fund, are you going to do follow-on funding as well, Trace?
Yeah, we plan to do a reserve strategy, about a third of the fund to do follow-on, depending on whether it's a pre-seed, seed, and to the Series A. And then we love our LPs, so we'll give co-investment opportunities as well. Want to educate everybody, want people to have skin in the game, and just overall just teach the tech world, because it sounds crazy and amazing and it's exciting, but there are nuances to it. But then also sometimes it's just not as complicated once you actually have a discussion about it.
Trace, do you have a specific industries that you like to invest in? Like, are you like more tech or medical or things, or is it you just pretty much open to anything?
So we've stayed away from medical historically. It's not our background. Generally won't touch anything that needs FDA approval because I have no idea how it works. And I would say 9 out of 10 founders that told me they have like a fast track to FDA. I met one last night. He's also been working on the company for 10 years. So he's been waiting 10 years. Took 5 years to get there, 5 years to get all the things in order, and now just waiting on FDA. And so regardless of the politics of the new government, it's going to be a shakeup always during a political transition. So I just stay away from any of that. And usually FDA is like invasive. I just have no idea how that works. And I don't know where the exits are. So I do all tech enabled to some extent. CPG isn't really tech enabled anymore. One of my better investments, I love them all my favorite children, but is a smart dog collar. So 6 years ago, I invested in like a Fitbit for dogs. It was hardware, which everyone was afraid of. Most still are. Defense tech and everything is kind of getting people back into it. But then I had to go SaaS. CPG, you reset the clock every year in terms of what your sales are. But what I like is analog to digital. That's why I'm a fan of AI. Most of these large corporations have some data. It's usually dirty data. Only a few people manage it. No people have access to it. And they don't know what to do with it. And once they figure out, maybe they provide some insights and they don't know how to execute it. So I like all of those. I don't like to be in the here's data, this is what you should do business. I like to be here's data and analytics. Now you decide what to do, because I don't want to be right or wrong. That's up to you.
But when you meet with people, what draws you to them? Would it be the team, the product, both things combined? Like, what makes you trust somebody that you would want to invest in them?
So always the team, because that's all we can bet on early on. And as I mentioned before, it's the grit, it's the hustle, it's the expertise. So we have a few benevolent dictators, solo founders, like, hey, board meeting. Okay, great, done. Let's do it. No more really than 3 founders is generally optimal. Kind of research suggests that, because then you have too many cooks in the kitchen, equity splits, and other forms of dilution that cause problems, who's on the board, and just too too many problems we've had in the past. And then the product. Hopefully, I just like the idea. There are certain ideas I'm just like, no. People send me like, oh, I have a new social app. Okay, not interested. Local SMBs, not interested. There are a bunch of tar pit ideas with first-time founders. That's great. Like a event tech, we'll never touch that. Marketing, sales tech. There are certain things we just know are hard nose, like dating apps. Met my wife on Hinge, but I have no interest in that business. Mostly, I don't think they're good businesses, but also everyone thinks that investors in the business of investing, we're in the business of exits. My job is to make money. I need to get in and I need to exit. So if you're doing some really cool technology, you can grow it to 10, 50, $100 million, someone will buy you. So that's what I'm looking for. As an angel, some people want early exits, but I don't think that's angel investing. I want to go big or go home. Like if I invest, I need to see a path to at least a 20x when this works. Ideally 100x plus.
Yep. Oh, yeah.
Next question or comment.
Yeah, hey Trace, Kyle here, and thanks, Bonnie. And then you've spoken a little bit about this already, but how has your due diligence changed, if at all, through the AI process? Obviously, there's a lot of folks out there with AI wrappers and nothing else, but has it changed for you much, or is it just the same fundamentals in terms of due diligence?
I would say the same fundamentals. Still the founders. Hopefully, if you're doing AI, you're technical to some extent. Like, where were you technical? A lot of people are just peeling off of like the big FANG companies, but internally, like if you worked at Facebook, unless you were like a deep data engineer, full stack, like trying to figure out how to keep their servers from like melting and burning down, like not in any malicious way, but like you probably were trying to increase like click-through rate by like 0.00001% by changing the shade of a color from like FF011 to like FF012. So like that's probably the hardest part, where everyone thought all these FANG and big tech people were brilliant, and they are. But you have to dive in deeper, get some more references and see what they actually worked on. That was something that people didn't really scratch the surface on for the last few years. And then I would say the hardest part is so many competitors, right? You can create an AI wrapper, make a few $100,000, a few $1 million with just a few people. But is that a good enough growthable, scalable business? And can you raise more capital, right? We invest in the rounds that are 500 to like 2 million. And so make sure your valuation is set properly. People aren't diluted. You have a ESOP, the employee stock options pool set up. You don't take on debt. You don't have too much liquidation preferences. Are you going to need a bridge round? So a little bit of the fundamentals of the game of venture capital as well. Like, will my friends in a year, assuming they hit their metrics and don't get leapfrogged, invest millions in this and just keep it growing?
Great insight. Wow.
So it's definitely gotten harder, especially the big companies funding all the big AI companies, but they're very general. They're going after the massive enterprises. So all I can do and what I've done historically is go after verticals. I would love an open AI, but they started at $1 billion. Now we're the 156 billion. Databricks, they're 62 billion, right? They just did the largest private tech deal in history to some extent, and is a top 5 IPO size comparatively.
Yep. Trace, what do you think of the IPO markets right now? I mean, yeah, I'm sure you know how garbage they are. Just, I mean, what are you thinking for next year and the year after?
All right, perfect. So let me put that. Let me get my post in here. So I have been writing about IPOs for a while, and
surprise.
Yeah, so here I'll put my post in here. Called "Make IPOs Great Again." So a play on words, nothing.
Love it. Love it. Love it.
That's direct message to everybody. Here we go. So you can sign up there, gated, all that fun stuff. They're coming back. So we've had 5 IPOs this year, and they're all doing relatively well. Some doing a lot better than others. So like Reddit, after 18 years, they IPO'd and their stock is up maybe 5x since their IPO. Clapio is up about 30-40%. Instacar is up 30-40%. Service Titan just IPO. Let's see where they are now. TTAN stock. They're at 105. So technically they priced, I think, at like 75. They opened at 100. So they're at 105. So technically they're up like 30-40%.
Nice.
And so there's an appetite for it, but
Yep.
we have 1,500 unicorns, most of which will be out of business and sell for pennies in the coming years. We've had down rounds, which isn't actually as bad as it sounds, but if you do a bad down round recap, it actually means your investors think there's something there. You were just overvalued and or missed your projections and maybe had some issues because building a company,
Misses.
right, building a company, you have to hire the right people. They don't hit their milestones. Maybe it's not the fundamentals.
Yep.
So there's maybe about 100 companies that can IPO. We just had Chime. They just filed a prospectus S1 confidentially yesterday, this morning. They were last valued, I think, at 21 billion. Who knows really what they're worth? We had Canva. They went from 45 billion to 20 billion to 26 billion. So the private markets are a little bit crazy. Stripe went from 90 to 50 back to 86. Databricks is at 62. Figma was supposed to be acquired for 20 billion. Then they had to go raise at like a 10 to 12 billion. So they'll be fine. They're doing a few billion in revenue. Wiz almost got acquired for 23 billion because Google is worth 2 trillion. They'll probably IPO in a year or two for 20 to 30 billion. So I'm not worried. But the IPO generally was a raising mechanism. You went out to IPO to raise more capital. But now that there's, once again, tens of billions of dollars, it's not really raising capital anymore. It's just how much can you stuff these companies full of late stage capital so I can get a return more in the private markets and still do well in the publics.
So Joe, I think you want to make a comment since I see that you just posted in the chat.
Oh, no, just another subject. Trace, your background is with family money and which is taxable, it sounds like. Have you guys done anything to optimize on either of the QSBS tax incentives around writing off losses and having tax-free gains, respectively?
Yeah, sure. An investment is a write-off. I don't know how you can write off QSBS, but definitely with some of our investments, they qualify for QSBS. So definitely a fan of it. We call it the gift that keeps on giving, and we do the rollover QSBS from one to another, depending on the sale, and we could time the investment within 6 months. But talk to me about the write-off of QSBS.
Yeah, the original QSBS law, which very few people know about, including folks in our government, is it's where the definition came from. It's called Section 1244 and allows you're part of the first $1 million, which it sounds like you guys are, that goes into a startup under QSBS terms. And if it fails, you actually write it off against taxable ordinary income. It's not a capital loss. It's a deduction. It's a better write-off than if you gave an equivalent amount to a nonprofit.
Interesting. Good to know. Definitely, I'll talk to our accountant about that. But the other side, the upside of QSBS, we're very aware of, and that looks like something that I keep telling people about every week, write about it, tweet about it, and everyone's like, oh, that's interesting. But right, it's 50 million assets, so we always qualify. The question is, especially the early stages, right? Do notes qualify? Those are debts, so no. Safes, maybe a post-safe. Some lawyers will argue for it. If it's post-safe, you know basically how much equity you're getting. It's closest thing to a price preferred equity round, but most of the pre-C these days, the first few million are not priced rounds. So it's been difficult to be that first million in because it has to be ownership of equity, not a note or a safe.
Yeah, the Y Combinator changed their template back in 2018 and put in language to hopefully qualify, but it's not been challenged through a court system. So yeah, there is ambiguity
it hasn't been
about
worth
whether.
it. No one wants to draw attention to big tech companies trying to get more financial incentives.
Exactly.
But yes, the Jobs Act, when it went from 75% to 100%, it's definitely one of those things that people rarely qualify for. But at least also in the fund, you can do the pass through as well, which is nice.
I'm putting some details for those that aren't familiar on QSBS in the chat box.
Yep.
Just got to Google Section 1244. Thanks for that tax tip, Joe.
Welcome.
Appreciate it.
Actually, just posted a link. So, next question or comment?
I mean, I don't want to dominate the conversation here, but I could talk to Trace forever. So Trace, what bring me through a little bit more of, you know, this IPO, you know, that you're talking about. I mean, I get, listen, I get that the market has been super soft with IPOs, obviously, and it's coming back is a great, you know, I'm very hopeful for that, right? But I mean, just, you know, the next couple of quarters, like what do you really see happening, you know, in those markets? Like just keep going, like deep dive a little.
So there have been more secondaries than IPOs in terms of the amount of money raised. And right, you do Stripe. Everybody wants into Stripe, into OpenAI, Perplexity, Character AI. Like the secondaries are really hot right now because of certain like discounts. But then you also have the SpaceXs that within 3 months went from 250 billion to 350 billion. So IPOs. 99% of liquidity in our world in the venture space comes from M&A. M&A
Yep.
has been non-existent. Lots of regulation, a little bit of Gary, a little bit of Lena. We can blame mostly Europe as well for their somewhat protectionist, backwards thoughts in terms of just all of it.
Sure.
So
Sure.
a lot of the big tech companies, because of AI, they've invested hundreds of millions and billions. As I said, they got leapfrogged. And so they actually, what I deemed it was called a hire and license. They didn't want to go through the process because M&A usually takes a year to close. Figma was trying to be acquired by Adobe. And after like 15 months, they said, no, we just can't get approval. Adobe had to cough up $1 billion in a breakup fee. So there's also a lot of arbitrage there in that. IPOs, stock markets are all-time high. A lot of the company fundamentals just weren't there because you'll go down my newsletter. You have to have about $500 million in revenue these days to be somewhat of a decent size IPO. And you'll go out and raise a few $1 billion, but you also have to have the fundamentals and unit economics there, where you have to be growing at least 30+% year over year. You can be a little bit loss, not free cash flow positive, but even ServiceTitan in their perspective said like, hey, we don't plan to be profitable ever. But they also had a compounding ratchet, which basically forced them to IPO. If you go back and read the coverage that said, we bought in, I think at like an $86 or $92. That was the last round when they were valued in like 2021, because that all those were really high. And so the later stage, they get protected with their 1x liquidity. And the ratchet basically said every month after May 2024 for ServiceTitan, we're going to take a compounding stake in the company and dilute people, all the early investors. They priced at like 75, so it really only diluted them by, I think, 1.6%. Still, that's $160 million out of the pockets of employees, founders, and early investors. So people are starting to file. ServiceTitan went public. They were forced to. Chime just applied. There's a whole list of companies we believe will go public next year, and probably they'll start in the first quarter, depending on the government shutdown. So not gonna do it in the first few weeks. They want to see what the Trump administration will do, who he's put in place. It's definitely very pro-tech, no question, with Elon, Sachs, Thiel, and just all of them behind the scenes. So the way I look at it is it will create a lot of liquidity. There are people sitting on tens of billions of dollars, VCs, employees, and founders. And I do believe that IPOs are basically trickle-down economics that hopefully when you create some liquidity and you get nouveau riche and you have some money, you'll start playing again. And that's really what the early stages are, is playing, right? Work at a company, you want to support your friends and founders, and it kind of starts the cycle all over again. But the last 2 years have been completely dead weight. There's been very few acquisitions, almost no IPO. So LPs are illiquid. They're over allocated because their stonks are way up, but their VC IRR is flat to down because of the time value of money. So the big guys, they're fine, or the big people. The Tigers, they all left. The Cotus, they all left. They all raised their own hundreds of millions. They're fine. It's always the small guys that have to deal and clean up after it when the tourists leave. Yep. So yeah, self-serving, but with a lot of these companies haven't raised capital in a few years. They've laid off 10 to 50% of the company. They've gotten leaner, but so has big tech. So they have to make sure they're growing and the economics are getting better, not worse. So I would say there's really 20 candidates for a good IPO next year, depending on pricing.
Okay, 20. That's it's a better number than the last 2 years, so I'll take it.
Right. It can't get any worse.
Exactly.
I also had Trace, I also had a question on in terms of geographically, are all of these investments that you're looking at on the coastal sides, or do you look into central non-coastal states and their activity there? I mean, from my viewpoint here in Colorado, obviously we feel there's no FOMO here, so valuations are kept more in line with what we really think can happen on the long term. But yeah, let me get your thoughts on FOMO and coastal startups originating all of the fanfare.
The simple answer is no. I am a New Yorker. This is where my network is for investors, expertise, and founders, and the West Coast. So LA and San Francisco. I guess the only coast would be like Israel, Tel Aviv. That's definitely a coastal city. But I just don't visit those cities, and I don't have a strong network there. Usually most of the investors in those cities, though, will find like a breakout, right? Like you left Qualtrics. So like, okay, maybe I'll consider it. But unless you're in those market, boots on the ground, it's just not something where I spend my time.
Sure.
I thought the geography doesn't matter anymore now that everybody's on Zoom or whatever platform they're using.
Yeah, there's not as much money there. You can look at all the stats. It's harder. If you want to build a serious startup, you have to be in a serious hub. If you're not in the top 3 hubs of like New York, San Francisco, or secondaries like maybe Miami or Boston, if you're doing crypto or medical or something in that space, you're just putting yourself at a disadvantage.
Exactly. Yeah. 100% agree.
Yep.
Trace, I got a question for you.
And Trace, just to go back to the other side of the spectrum, away from IPOs, early stage, you're talking about safes. Is the safe structure, as you see it, still kind of the standard for early stage seed A kind of rounds?
Yeah,
Or...
it's cheaper and faster, as much as we want to pontificate that a price preferred equity round is the proper way of doing it. And a lot of people, because they got burned, are now coming around to like the protections that a priced equity round can give you. Safes, it is a lotto ticket. We try when we invest in them, and when we eventually lead rounds with a new fund, we'll hopefully do mostly price preferred. We'll do a few safes, but they'll be the closest thing possible to a price round, right? So we want information rights, we want pro rata rights, 1x liquidation preferences, and potentially a board. Everyone's like, oh, a board at that early stage, like it'll just get in the way. Like, we're your friend. We're not going to vote against you fundamentally, but we call it training wheels. So many companies get out of whack because they don't answer to anybody besides themselves. And once you start skipping updates that aren't monthly, direct correlation. My best investments send monthly updates. People think that's too much. That's just how the best founders track month to month growth, changes, and they keep their investors updated. So when they need more money, we know exactly how the company's doing. Yeah, make price rounds cool again. They're a little bit more expensive. They take a little bit longer. It's more documentation. So we argue like in the long run, but yeah, if you're going to spend a few $1,000s on a safe or a few $10,000-$20,000 on a price round, get Cooley or whoever involved. Yeah, it's hard to convince a founder to do that when they're raising like 500 to 2 million.
Exactly.
It's harder than it needs to be. It's not that hard.
Yeah.
Yeah.
So I know John had a question too.
Thank you, Bonnie. So my question, Trace, you had spoken about relationships, monitoring relationships between founders and co-founders, and you also talked about implementing boards early on. So I'm wondering, how do you go about finding people to put on those boards, or do you do it yourself? What that process looks like, and at your level, all the way up to the tier 1 Edgerton type of investment firms?
So the early board structure hopefully would be 1 or 2 founders, depending on how many there are, and an independent. Generally, the independent is chosen early on by the founders, usually like their friend, just as like a formality that 99% of the time will vote with them. Though in the pre-seed and seed, there isn't really much you have to vote on. Maybe if you're going to spend over $25,000 or $50,000, just so there's like a discussion about it. We will take a few board seats. If we're writing a $500,000 plus check, depending on our involvement, who else is in the round, and then just seeing it with our investments and the rounds where the VC is led. Usually the pre-series seed, they'll try and stay on as long as they can. It's definitely like a trophy, like, wow, I've invested the pre-seed, I'm still on to Series B. But usually later money talks, and they generally require a board seat, and the board can only be so big. You usually also want an odd number of board seats. So that sometimes is an issue as well. You don't want to really get above like 5 or 7, like you're not that big or special of a company. But we have a lot of board observer seats. So we don't have an actual legal say in the company, but we want to know what's going on, and we want to be a confidant. Generally, we're like the first few calls, depending on the situation, with the founders that we invest in. I text and DM and tweet at them all the time. It's a lot of fun.
And I'm asking because I'm really into deep tech in general. And as you're probably familiar with, deep tech is, or can be, or is inherently a risky investment. With that said, I think that one of my side projects is developing a marketplace, something not deep tech, but serving the deep tech space, where investors can find board directors on this marketplace and democratize access to that role. I think this would kind of lubricate, I guess you can say, the whole process of getting deep technologies out into the world. And I just wanted to hear your thoughts on that.
Fundamentally, I don't agree with that. If you are building a board, it's hopefully of people that you know. So it should be your investors who have skin in the game, an expert or an advisor who actually understands technology, because there's no incentive. Like, oh, okay, I'm a marketplace. So sure, there are certain people I want to get in touch with. If you can get these amazing experts on the platform, and for some reason they want to work with my random company, I guess I apply, and you do like a dating app matching to some extent. Like, they don't know me. Like, people throw out the word mentor. 99% of you are not mentors. If you don't know like their spouse's name, their kid's name, like a birthday, or like where they live, if you don't see them like once a month at least, or catch up, or know how the company's actually doing, the co-founders, like what their background is, like you can go on LinkedIn. Everyone's an advisor and a mentor. So sorry, I'm not sorry, but most of that's bullshit. And so fundamentally, I don't agree with that marketplace, just because if you don't care about the founders, why would I want you on my board?
Who's to say that they wouldn't care about the founders though? I mean, these are long-term relationships that you're developing, right? And I'm sure I get what you're saying. A marketplace typically is an in and out type of transaction.
Right. As long as it's not transactional. So I think a few people will get value out of it, but systemically, I call it kind of like a conference or a trade show where you have like 100 people there, maybe like 5 to 10 people will get value out of it, but the other 90+% are like, oh, look, they got sales. Like, I'll come back again. Like, maybe that can be me next year. And like, if these people are truly experts, they should have their own connections. They shouldn't kind of look in the marketplace. So it's kind of like a catch-22 to me.
Interesting. Okay. Appreciate your insight.
I also just don't like marketplaces, if you can't tell. I don't like the business model.
I appreciate that. Now I can take things with a little bit of a grain of salt.
I don't like affiliate revenue or non-SaaS stackable, predictable revenue.
So next question, I think I interrupted Alex. Did I interrupt you before because I saw that John?
No. I had the question about the safe versus priced rounds. Which
Safes, they work, they do their job. They were invented to just be simple, quick, and easy. I've tweeted with Paul Graham and Jessica Lesson, like who created it, and like it's in my tweet somewhere from a year ago. Like, they weren't created to be bridge rounds. Lawyers created bridge notes because they were cheap and easy, and they got you like a deal with a client. So they definitely created perverse incentives and got bastardized over the years, but they serve their purpose. As long as you don't stack them. But yeah, when I see someone doing like 4 or 5 bridge rounds across different notes and safes and different valuations, you're just screwing yourself because you have no idea how much you own. And then when you convert it, you're like, oh crap, I got diluted by 35%. I had no idea.
It was a Dale Resi who created the safes. He worked on it with Wilson Sonsini. He was the first one.
Right. And they were created because they can spray and pray into like 50, 100 companies. It would be easy.
And he only meant it for very, very early stage startups when the whole idea came about.
Right.
I think it's also a function of a lack of real valuation expertise from both investors. And then entrepreneurs aren't expected necessarily to be experts in valuation, but I think that was a big part of it as well. It was a poor solution to increase the velocity of investing.
Yeah. Yep. When investing gets too easy, people think they're smart, and that's when you lose.
Yes.
Right. Like during ZERP, I had a lot of friends like, oh, I'm making so much money, I'm quitting my job. Like, no, you're not smart. You just stonked and swung up, right? Oh, I got markups. Well, did you really? Right? Like, do you know how much it's actually worth? Do you know if they laid off, if the CEO's left, like how the company's actually doing fundamentally? No, no idea. That's the difference between what we like to call like an angel hobbyist and a professional angel.
What do you think are the appropriate criteria of somebody that's experienced and track record and like of a professional angel? Because I've never spotted one really.
Oh, well, I haven't done my job then. So my father, I would call him a professional angel. He ran the New York Angels in New York City. It's one of the largest, most active angel groups in the country for 10 years. And as a professional angel, he ran the group. He put in a process. We had to do diligence on the companies. We brought in experts. We structured rounds, and we leaned in on the companies. So I would say, right, we're a micro VC to some extent, where we would invest, we would add value. We did talks. He actually wrote the book on angel investing. You should go read it. It's on Amazon. What every angel investor wants you to know. The foreword is from Ben Silberman, the founder, CEO of Pinterest. So talks by Howard Morgan, all in there. So a professional angel, it's not just, oh, I'm going to make a few investments every year. My best friend's college roommate's son, he has this new social app idea. Let me see how that's doing. So I'm talking with other GPs, LPs, family offices, and that's the majority of non-tech professional investors. And they get burned. They're like, oh, sure, here's $100,000. Like, good luck. Oh, you're doing an uncapped safe? Okay, I don't know what that means. Oh, I get a 20% discount. That sounds like you're giving me a really good deal. And we're just like, you took advantage of your friends and family, the people who were there for you first. That's a red flag. I don't want to do business with you. And we're thesis driven. We know what we don't do. We are price sensitive. So you have to just stick to your guns. There's always exceptions and outliers, but there are definitely professional angels out there. And hopefully they will invest in what they know and not go beyond their skis or outside their lane. And not annoy founders. That's the worst. When they're like, hey, tell me what's going on. Let's catch up. And the founder's just like, all right, you gave me some money. Like, okay, fine. Let's catch up.
Well,
oh, you can't help me? Too bad. Didn't realize that.
Well, that's on the founder then, to your earlier note about monthly updates, right?
Yeah, and then they want to like catch up because they're like, oh yeah, the monthly update. Let's talk about it. Okay, cool. You talked about it, you ran me through it, but like, okay, I still can't help you this month. Founders' time is the most precious. I only chat with my founders, like fun because now I have a good rapport with them, but like historically only when like they need us. Too many people waste their time. And you know what? They waste their time too. So sometimes that's why we like the board or training wheels just to keep them online, where they do work that keeps them busy, but it's just busy work and not real work.
Grace, I just wanted to ask, curiously, in regards to AI and going forward, do you feel at the present time valuations are too excessive, or what are your thoughts on that for startups?
Most of them are, no question. And some are justified. They're technical founders. Hopefully, like they can build it depending on what their background is. As I said, if they came from Fang, maybe a product manager, they know how to build and manage a product. But then you have on the other side all these PhDs from like DeepMind, from internal at Microsoft, at Google, at Meta. They definitely are smart, and they command, just by themselves, they're getting paid millions of dollars a year, just as a salary, total comp, even more. So you can't really undersell some of these founders. Should they be raising 10 on a 50 million? Yes and no, because they need time to build a product. Servers cost a lot of money. I'm sure you've seen all the AWS's and Azure's CoreWeaves and NVIDIA's. Their stocks up until yesterday were going through the roof because of compute power. It is expensive. So the valuations are relative to dilution. And so if you're raising a $10 million round, you have to go hire someone who you have to pay $300,000 to $1 million a year. You can give them some stock as compensation. I'm sure they're doing just fine. But half of that is just going right back into servers. So really, you only have half of that budget to actually invest.
Hey Trace, just it's somewhat of a self-serving question, but for a founder, looking for that kind of seed or A round, you mentioned New York Angels, etc. What are what's the best way to get in front of a lot of people quickly if you want to raise money, at that level?
At the pre-seed seed, it depends on your traction. Hopefully that speaks for itself, your expertise. Hopefully you have some type of a network. For the New York Angels specifically, they do pre-seed and seed. So they have an application process online. If one of their members is an investor, they can fast track you in to at least give a pitch because someone's putting their reputation on the line. Otherwise, people build in public. They go to events and they cold email investors. And they try and go viral to some extent. So like you have to be a thought leader, right? I do a lot of content. Great. I'm in front of 15, 20 people. I'm going to a dinner tonight. I go out to events, curated, no more big events anymore, and build relationships. It takes time. It really does. Yeah. And so you have to have kind of people wanting to come to you. There was a post yesterday. Are you a hunter or a gatherer? The top VCs, they hunt because they know what they're looking for. And generally at the Series A plus, the companies are somewhat public, like they've announced their pre-seed or their seed. They've seen the founders post about it, their thought leadership. They have the data about who's growing. And so they kind of know what they're looking for. At the earlier stages, pre-seed and seed, we're gatherers. We have to kind of go out and find what we know we're kind of looking for. But until we see it, we don't know if it's good or poisonous.
I'll just add a quick thought to that, Alex. I've worked on the startup side more than the investment side. Dig your well before you're thirsty. You got to start that process well in advance. Don't wait for the day you need that money.
Yeah.
Oh yeah, expect 6 to 9 months to raise right now.
At least. It might change come January in the new administration, but I found a lot of investors are holding off. Wouldn't you say?
Yeah. And either way, when I tell my companies, if you raise 16 to 18 months of runway, you have to hit your metrics in 12 months because it's going to take you 6 months to raise. And you always want to be in a position of power, not when you're running out of capital.
So next question.
That's how you know you're working for a good startup. If they're not looking to raise money and people are throwing money at them.
I have another question. In terms of exits, Trace, have you seen private equity getting their hands on this space a little earlier than usual, right? I mean, private equity usually is established businesses or SMBs, but what are your thoughts on private equity and getting closer into the exit territory of the startup world?
At the early stages, no, because there's no real IP tech and maybe they can buy some people. They're definitely active at the later stages, doing a lot of secondaries right now, and they're trying to do some roll-ups. Just because there's some great technology and great people out there, but the business just didn't work and they can't raise more capital. So we at least are saying right now, there's a lot of activity behind the scenes. They're kicking the tires on a lot of companies and trying to open the books, and some are hesitant to do so. And there's been a lot of take privates. So a lot of valuations have come down in the public markets. And so they've been very active taking companies private because they've been sitting on their powder for a while. And if companies haven't gone up, they might be undervalued, underappreciated, or don't have a good story. So they do later stage these growth because they deal in the billions of dollars, but the early stages, not really.
Yeah, no, that makes sense. And that's what I've seen as well. So thanks for that.
Yeah.
It always seems to shift around. Either investors will look at only the early stage, or then, it's harder to raise Series A or Series B. It's an odd little thing. And I wonder why that is at different stages. Or at different times, I should say.
Markets where they think everything's going to be in a few years. So like, right, I invest for a few years out. I'm a PE guy, but a lot of these big VC funds are turning into private equity.
Yeah. Oh, I think Andrea is able to introduce herself, and she might even have a question too. Andrea, do you want to introduce yourself? She's always multitasking. She's family office. I guess she's not.
Yeah, sorry about that. Yeah, I was in the elevator. Hi everyone. Nice to see a lot of familiar faces. Andrea Liu, recovering attorney, investor both personally. I got into crypto like 16, speculated heavily into it. Just a bunch of real estate. But right now, I'm trying to be fairly disciplined about getting into tech earlier stage. But occasionally we get tempted by things like XAI. So this was a really great conversation around all things. And I do have some questions. This is such a great discussion.
Sure.
Especially around maybe valuation, but also, can you guys talk about, especially Trace and Joe, etc. Talk about the different ways funds have, tinkered with their numbers so they appear to be more favorable, whether it's the DPI and whether you see value in things like tokenization, and what the IPO market really looks like when it opens up again, especially with the secondary market being so robust.
So valuations. Hi, welcome. Looks like a nice hotel. Valuations are always a game, and so I need 100x at least at my angel and emerging manager size to have like a fund returner. Some of these other big VCs that are investing 50, 100, $200 million. So if they get 10x, that's $1 billion outcome, and that can return a significant piece of their fund. So at least from that perspective, they just need to put in like great into OpenAI, like $1 to $5 billion. If that just 2x's, if they IPO for 300 billion, like they return their fund on one investment, that is very de-risked. Someone asked me like, X.AI pitched me at $18 billion. Like, what do you think? I'm like, first off, you don't bet against Elon, however you feel about him. They had no financials, they had no information. I said, look, the biggest, smartest people are behind it. Like, it's not going to zero in the next few years. Like, it's just not going to happen. But it went from 7 billion to 18 billion in 6 months. Like, these numbers are, I would say, like Goo Gaga to some extent. You can't justify them, but they're not that crazy. I don't know how much revenue he's doing. He built the biggest AI cluster. The metrics is definitely a difficulty. Each fund has to show off their best. So is it MOIC? Is it TVPI? And why are they showing me this number and not another? You can't fake DPI because that's literally, I got an exit and I gave money back. And so I take a little bit of issue with the manufacturing of DPI that a lot of LPs are acquiring these days from a lot of my friends, where they have like a good 20, 30x. They got into a great company, and maybe in a few years it could be 100x. But to raise their next fund, LPs want liquidity now, which isn't the game that we're supposed to be playing. You want liquidity in 5 years, like you are invested because this is going to take 8 to 12 years. So I can create DPI now, great. You can get some pennies, 25, maybe 50 cents on the dollar back. Is that really going to make you feel better to like your boss? Yes. Is it going to hurt me long term? Because maybe instead of a 2x, I could have been a 4x fund. So at the bigger stages, they literally are just paying themselves. They do a lot of continuation funds. And so they literally just spin up a new fund. They pillage their current portfolio, take out the best assets and leave the worst ones in there. And they sell it off. They get another 2 and 10, depending on what the fee and carry is. And they push off the risk to somebody else. So definitely an unfair advantage that they have that we can't do. You're on mute.
No, I was just saying, thank you. Yeah, that was great. And then maybe the valuation, are you seeing, I don't know, just kind of the open.
Outside of AI, valuations are relatively reasonable because it's so hot that everyone's like, oh, anything that's not AI, everything is AI. They're all using API calls, they're all wrappers, and that's fine. It depends how you're using it, which is why I prefer vertical AI, because I'm not investing in X.AI, Claude, Perplexity, any of them, because they start at hundreds of millions of dollars in valuation. So if you're AI and you're brilliant, you're a PhD, as I said, leaving Fang, like, yeah, you're getting tens of millions of dollars, no questions, an optionality check. All the major LPs, endowments, foundations, and really big family offices expect the Sequoias, expect the Andreessens and everybody to get into these companies. Like, I know they're pressuring them, like, oh, why didn't you get into that one? Oh, there's 30 major VCs out there to some extent that control 75% of the entire LP market. And so if you didn't get into OpenAI, you have to get into another one. So expect that there's about 30 major multi-billion-dollar AI companies, because they all have to have one. Otherwise, they're a disappointment and an embarrassment to their LPs.
Right.
Like, why didn't you get into it? You're supposed to be the best. You told me you can get into OpenAI. You only got into Claude. Oh, that's only 9 billion, not 156 billion. No more money for you.
Cool. Well, thank you. And yeah, your dad's really cool too. Thanks, Bonnie. Thanks for
thank you.
Yeah.
Awesome.
So I think we have a couple of minutes left if you want to one more question, if you want to leave us with some sage advice, Trey, since you are our last speaker of the year.
Don't FOMO. The one great thing about startups, we were talking about being a professional investor, is angel exhaustion at the early stages that everybody experiences. They find a cool company, they think it's the best thing because they're not in the tech world, and they say, great, I'm going to invest. And then like after 36 months, they have a huge amount of regret because they didn't know what they were doing. They made a big mistake. And the best thing we say, if you want to get into tech, spend 6 months learning about it. Try and become not an expert, but at least enough to be dangerous and be helpful with your founders, because our best deal flow comes from a founder network. When they have their friends in the industry, they're like, oh, I'm going to go raise around. Great. Go talk to the Cohens or their new funds. And the best thing about startups is there's technically not a shortage of them. There's definitely more demand than supply right now, but there will always be another one. So try to have as little regret as possible and only invest what you can lose.
Oh, thank you. Any words of advice for the founders too, since we have quite a few founders here?
Maintain that burn, maintain that potential cash flow, raise what you need, half your revenue projections and double your expenses. It's still rough out there at the early stages. If you're not one of these 1%er founders and your product hasn't really gone viral yet. So I would say more traction, more position of power as possible. And don't try and optimize around the highest valuation. That's short-sighted. Do what is best for the company.
Thank you so much for your time and insights, because I know you've been at this a long time. And do you think that it was really beneficial that your dad, who's Brian Cohen, I'm going to name him, made all his kids start companies? That was out of school. Every single one of you were required to start a company, which I'm sure was a great education, especially even in investing.
Yes. So fortunately, I started my first company in college. Didn't know what startups were in 2006, but majored in entrepreneurship. So with my best friend and roommate, started it, and it got me down this career path. As a Jew, I'm supposed to be a doctor or a lawyer, so maybe some disappointment. But my parents were founders and entrepreneurs, and it definitely gave me a unique perspective on the world. So sometimes the grass is always greener. Everyone thinks they should start a company, but they don't realize that there isn't really much to do early on, and you actually work harder for less.
Yes, you do. Thank you so much, Trace. I really appreciate it. Everybody have a great holiday, and we'll see
Yes, you too.
Thank
Yeah, I guess we won't see you before,
Find me
we'll
on
see you
LinkedIn,
after the
everybody. I have to
holiday.
drop for another call. Thank you. Find me on LinkedIn, Twitter.
Thanks,
I'm all
Trace. It was
over.
great info.